this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a lot of great information today. Of course, we've seen a lot of market movement, not only the stock market going down quite a bit, but also the bond market. In fact, I've talked repeatedly and I tried to express concern to all of my TV listeners. Take risk off the table if you own bonds. In fact, I'm going to talk more about bonds today, and I firmly believe the biggest risk asset you have in your portfolio is bond mutual funds or bond investments, especially if they're midterm or long-term bond funds. I can't tell you how many calls we've received in our office in the last few weeks. Investors who realize now that bond funds can go down 10 or 15%, just like the stock market can. In fact, the problem with most bonds right now is rates are so low that when rates move up, as we saw the last few weeks, bonds have fallen in value. In fact, government treasuries, long-term treasuries, which are perceived by many investors as one of the safest investments out there, had some of the biggest volatility the last month or so. In fact, the long-term treasury dropped around 12 to 15% in the last 60 days or so. 12 to 15% in value. At the same time, the S&P or the stock market only dropped about half of that. So what really has more risk? I would tell you the bond market does. And unfortunately, too many retirees or investors who don't understand the risks in these funds are not going to be very happy campers over the next 3, 5, and 10 years. You probably won't realize the losses that are going to mount year after year. And often it takes investors a long, prolonged period of time of their assets going down, down, down before they make a change. If you have any questions about your portfolio, if you own bonds in your portfolio, call the number on the bottom of the screen. We're going to take calls right now into the TV station. I'll answer your questions about your portfolio. Better yet, go to my website right now, reznywealth.com. We have a free report for all of our TV listeners. It's called How to Avoid Outliving Your Retirement, your money during retirement. It is so important that retirees realize bonds are not going to cut it. If you want to avoid outliving your money during retirement, go to my website right now for free. We've published a special report, and you can get it only by visiting my website. Go to reznywealth.com, and we're going to go to some calls right now and questions that our investors have about their portfolio. And again, if you have a question, please call me in the studio now. Get the question answered. It's easy. You call that number, you give your question to a studio producer. I'll answer it while you watch the TV. Sal in Marco Island, what do you think of gold? Oh, Sal, I hope you don't own gold. And in fact, I've been telling investors since the end of December 2012, over 6 months ago, to sell gold. One of the things we do at Rezny Wealth Management is we are not buy and hold investors. Risk management is an important part of how we manage portfolios. In fact, it's different from that failed pie chart asset allocation most investors fall prey to. What we do with our client portfolios is we look at all asset categories, not just the stock and bond market, and certainly not just gold, but gold is one of the asset categories we do review. Back in December of 2012, gold started getting weak within our strategy system. As gold became weak, it fell out of our top 5 ranking that we hold in client portfolios. When it dropped, we sold it back in December, at the end of December 2012. My clients are glad we did. It was replaced actually with the iShares IJH, the S&P 400 midcap, because that moved up in the rankings into our top 5. Let me tell you what's happened since. Gold has actually dropped to about a 2-year low, over 22% year to date. The IJH has actually moved up over 10% year to date. Now, of course, all investments have risk, but one of the things I try to stress to all investors, if you blindly believe asset allocation, buy and hold is an effective strategy, it is not. You need risk management, and there's times all investments need to be sold. Sal, I would not touch gold with a 10-foot pole because it's currently ranking towards the bottom of all the asset categories we review at Rezny Wealth Management. If something's relatively weak, it typically continues relative weak. Assets that are typically relatively strong continue on that track. When they change direction, we make adjustments to our portfolio. Gold right now, to me, is another big risk asset, and I firmly believe it'll probably get lower before it goes back up. Tim in Naples. I have most of my IRA in bonds or bond funds. What are my thoughts? Tim, great question. If you have most of your money in bonds, you're taking the biggest risk of all. Two things can happen with bonds right now. Either rates are going to stay fairly flat over the next 3, 5, and 10 years, and your return's going to be mediocre at best, certainly not above inflation on most bond funds. If rates start to move up slowly, your principal's going to start going down. Rule of thumb, on an average maturity bond fund of around 10 years or so, a 1% interest rate increase will cause that bond fund to drop approximately 10%. So at the end of the day, if you have most of your money in bond funds, you would be a good candidate for an interview with my firm. Call my firm for a consultation. We can sit down and really show you how real money management works, how we can give you and show you how you can have risk management. But I firmly believe if you have most of your money in bonds, you're taking the ultimate risk, which is either no return, probably bigger, is downward spirals in the portfolio value that you have when rates slowly move up. Your portfolio probably in the last month alone, with the spike of interest rates we've recently had, has probably dropped between 7 and 12%. That's a mistake, and that needs to be avoided. If you're like my last caller, excuse me, call me in the studio right now, 239-417-4711. We're taking your calls. It's easy. Call up in the studio, give your question to a studio producer, and we'll make sure we answer your question so you can make a better decision. By the way, I'm going to put my website up on the bottom of the screen. If you'd like to go to my website, we have a free report available right now, How to Avoid Outliving Your Money During Retirement. It's only available on my website, and it's a must-read for any retiree, pre-retiree, especially you conservative investors. Go there right now. The report is free, but the information is invaluable. You will learn a lot of information from this short report on how you can avoid outliving your money during retirement. Kevin in Fort Myers. I have an advisor. He's pushing a variable annuity for my IRA, approximately $1 million. Is that a good idea? Absolutely not. Annuity should be avoided at all costs, Kevin, especially inside an IRA. What you have is a salesman or a broker who uses the title advisor. He's working under what's called suitability. You're suitable to buy a mediocre variable annuity with horrendous expenses and a big back-end surrender. Don't do it. Get a different opinion. Call my firm for a consultation. The average variable annuity that we review, when somebody comes into my firm, the average annual cost against your return is often 3 to 5%. The investments inside many of these variable annuities, Kevin, are mediocre and limited at best. And you're not going to get any real advice from that so-called advisor because he's not a registered investment advisor or a money manager. Don't buy the annuity. You'd be making a big mistake, and you would be insanely tying up your money for as long as 6 to 9 years. I'm going to take a short break, and I'll be right back with your calls after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hello, we're back and you are listening to the Rezny Wealth Report. If you have questions about your portfolio, if you're concerned about your money, call me right now. The studio number's on the bottom of the screen. When you call, you can give your question to a studio producer. You don't have to go live on TV. We'll take your question and I'll answer it so you get the right answer so you can make better financial and investment decisions for the safety of your retirement. You know, we get a lot of calls all the time on my TV and my radio show. By the way, I do have a live radio show every Sunday from 10 to noon throughout Florida. Go to my website for times and available stations at reznywealth.com. I know that I've been getting a lot of calls into the studio tonight, specifically about our free report. Our report is free. It's called How to Avoid Outliving Your Money During Retirement. Go to my website right now. The report is free. It's at reznywealth.com. And if you want to learn about proper investing, how to control risk, how to know if you have a real money manager or a wolf in sheep's clothing, go there right now, download the report. It's free, but it's got invaluable information that'll help you succeed with your retirement. Barb in Fort Myers, can you explain fee-only and fee-based? Barb, great question. We've got more information about fee-only and fee-based registered investment advisors available on our website at Rezny Wealth, but let me explain this. Most advisors really are acting in a stockbroker capacity under what's called suitability. They're commission-based. Some of these Wall Street firms and insurance companies also carry what's called a registered investment advisory hat. So they're brokers on one side, they're registered investment advisors on the other. They would be fee-based. Any of these firms have all the same conflicts of interest as a commission-based broker because they overlap. Okay? So basically, if you want conflict-free money management without the shenanigans at all of people at the bank investment department, insurance brokers, or Wall Street brokers, you would want to use a fee-only registered investment advisor. These individuals only manage money and are only compensated by you. They don't get under the table deals or revenue sharing or special trips or incentives to offer investment products. They're only paid by you, the customer, and they act in a true fiduciary standard of care. Fiduciary means in your legal best interest. Stockbrokers and fee-based advisors often work under what's called the suitability standard of care and maybe the fiduciary standard of care. What the difference is, as long as they talk about the conflicts that come against you and your money and you sign off on that, which unfortunately most people don't read the fine print, they can do the same practices in a fee-based account often they can do in a brokerage account. So the only kind of firm you want to utilize is called a fee-only registered investment advisor. This way you've got a firm that has to work legally, always in your best interest. Bill in Punta Gorda. I own approximately 90% of my portfolio in mortgage REIT stocks for income. What am I missing? You're missing a lot. In fact, you're missing a lot of return